Stock and commodities markets. When you watch the news, you may hear a reporter saying, "The market fell 2 points today." But what does that mean? A stock market is where a company's shares of stock are bought and sold. Stocks, simply put, are shared ownership of a company's assets and profits. A person who owns stock in a corporation is a shareholder. Stock is the capital, money, raised by corporations through the selling of their shares. The value of all of a corporation's shares is called its market capitalization. This is how much money the company is estimated to be worth. There are stock markets in existence all over the world. Some of the biggest and most well-known are the London Stock Exchange, the Tokyo Stock Exchange, the Frankfurt Stock Exchange, and of course, the New York Stock Exchange and the NASDAQ, a technology company's stock exchange also based in New York City. Corporations listed on a stock market try to make money for their shareholders by increasing their market appeal through good performance. This results in an increase in the share price, and increased profits can be passed on to the shareholders by way of dividends, a share's portion of the company's profit, usually paid out. Investors buy and sell shares on a stock market, most commonly through a stockbroker. For a commission, stockbrokers arrange the sale and transfer of stock from a seller to a buyer. Another way of buying shares is through a bank or other finance house, as they often have a trading arrangement with a stockbroker. Shareholders hope that over time, the share value will increase. Unfortunately, the value of shares can fall, sometimes overnight, because an event may trigger the mass selling of certain shares, so they become less valuable. Although prices can fall, historically, the trend is upwards for shares in stable, successful companies. A savings account entails no risk to your money, but you will gain little in interest. If you invest in shares, you do take a risk, but stand to gain much more from a wise investment. As an individual, you risk losing money through a fall in share value. Managed plans give you the benefit of shares while reducing your risk through portfolios of multiple share types. Commodities are the raw materials of products that we buy. Chemicals, foodstuffs, base metals, earth resources, and any other bulk-produced product can be bought and sold on a commodities market. Commodities exchanges include a commodities index is a weighted average of selected commodity prices. Indices include commodity markets are where commodities are bought and sold in standardized amounts. When a commodity is traded, it has 4 attributes: a value, a use value, an exchange value, and a price. How much it is bought or sold for is derived from these 4 attributes. If oil is being traded, it would be very valuable to a country that does not have any of its own. If a country has lots of oil, it can become very highly priced if that country hangs on to it. These factors dictate the price. But because the commodity is traded all over the world continuously, the price stabilizes as market forces ultimately control it. If the price of oil rises, then everything made from it, paints, plastics, fuels, etc., all go up. As you discovered earlier, inflation is the sustained rise in prices, and your money becomes less valuable. For more information on commodities trading, go to the New York Mercantile Exchange webpage on how the exchange works. On the news, you will often hear how different averages have changed in value. These different averages are indices of how the stock market is doing on a whole. There is the Dow Jones Industrial Average, which is the average value of 30 large industrial stocks, while the S&P, Standard & Poor's 500, is an average of 500 large companies. Blue chip stocks are stocks from very stable and established companies. They pay regular dividends to their shareholders and have limited liabilities. They are usually expensive to buy for those very reasons.